There are two sets of people I usually come across. The first are those who are too afraid to take risks. They are unwilling to move from savings into investments. They believe that their savings are protected at the end of the day. But the fact remains that inflation tends to erode savings over time. There are also investors who proactively trade in the market, those who are unafraid to take risks. The problem is that at times they tend to take too much risk and end up losing money. Today's video is about how not to lose money in the stock market. Welcome to the channel Finance and Investing for All. Now, if you are new here, please click the subscribe button. Also, comment below and let me know what other topics you would like me to cover. We're going to cover a few important ways on how not to lose money in the stock market. They more or less are all interrelated. However, there is one key element that ties them all together. We're going to talk about that at the end of this video. The first one to remember, however, in my opinion, probably second in terms of importance, is the need to do adequate research. You need to know as much as you can about a stock before going about acquiring it. I can't stress this enough. Now, how many of you out there, including myself, have purchased stocks based on the recommendation of a friend, a relative, or even your boss for that matter? Here's how it goes. You hear about a friend or relative having made an easy 5 or 7% on a particular stock. Let's assume you are disciplined and you hold on to any purchasing decision. However, that friend the very next week makes 10 or 12% on that stock. What do? You take a position. And what happens then? The stock crashes. Now, this is what's commonly known as herd mentality, or a theory known as castles in the air. What it means is that you go about acquiring stocks without knowing anything about it. You just go along with what the market determines. When you acquire shares, you are investing in that company. You are taking a piece of ownership in that company. Ask yourself this question: do you want to own a company which has no future potential? Doing your own research means that you need to know about the fundamentals of the company. You need to know the industry in which it operates, its competition especially. You need to know about the management, the company's present and future earnings potential. I'm also going to strongly recommend that you focus on the risk factors. There are too many people who tend to pay attention on the positives. And while there's nothing wrong with that, please spend some time on the things that could possibly go wrong. Diversification is also one of the most important concepts out there. However, it's probably the least followed. Guys, please do not put your eggs in one basket. Now, maybe you found that perfect stock with an excellent management and even better earnings potential. But the fact remains that you never know what could go wrong. It could be an internal company scandal, an accounting fraud, or maybe a better product or service offering out there. Maybe the industry has taken a downturn. Or just maybe investors find the stock a little too pricey. Diversification can be achieved in many ways. In a stock portfolio, you could have aggressive stocks, defensive stocks, dividend-paying stocks, and even speculative stocks. You could even have a portfolio comprising of international and domestic stocks. Maybe you want to even include bonds and achieve an ideal portfolio balance. There are people out there who tell you that diversification tends to put some form of brakes on the earnings potential of your portfolio. While this is true to a certain extent, keep one thing in mind. Investing should be about maximizing profits and minimizing risks. It shouldn't be about maximizing profits and maximizing risks. Being too reactive. Now, as an investor, you need to get used to the fact that there are going to be daily ups and downs in the market. However, you need to develop some kind of internal mechanism whereby you tend to ignore the market noise. If you've constructed a well thought out, well diversified portfolio and you focused on risk factors, then you have nothing to worry about. You need to stop checking your portfolio on a minute by minute basis. Trust me, by looking at your portfolio, you're not going to actually increase your earnings for that day. Being too reactive means coming under pressure or even panicking and selling your portfolio at the first sign of some form of market downturn or market correction. Trust me, you're doing yourself no good. If you've constructed a well diversified portfolio, you have, I repeat once again, nothing to be worried about. It also means selling your winning stocks too soon and holding on to the losing stocks for a bit too long. Now, if your winning stocks have exceeded their target price, then by all means do sell them. However, if you sell your winning stocks too soon, then what you're indirectly doing is that you're limiting your earnings potential, because at the end of it all you're left with is the stocks which haven't done so well. Please avoid timing the market. There has been a bunch of research that has gone into this subject, and the fact remains that it simply doesn't work. You too could be well versed in the market, but the fact remains that you never know what could happen next. Timing the market means buying when stock prices are low and selling when they are high. The fact remains that most of us do the opposite. Let's say you find a stock that's a bit too expensive at the moment and that you expect or want its price to fall down a bit. But what if that never happens? Well, in that case, you've missed out on a good earnings opportunity. Instead of trying to time the market, a better option or strategy is to adopt dollar cost averaging. Now, rather than investing in the market in one shot, a better option would be to invest smaller amounts over different time periods. Let's say every month, every week, or every quarter. A fixed amount goes every period into your stock portfolio. Now, over time, this has proved to be a better method, especially for the long haul investor. At the outset, I mentioned that there is one factor that is more important than any of the elements that we've covered here so far, and that factor is emotions. Remember this. Emotions can be your best friend or your worst enemy when it comes to the stock market. By emotions, I specifically mean patience, fear, and greed. Investors who are fearful or those who are not patient will likely sell off a well-constructed portfolio during a market downturn. On the other spectrum, investors tend to take unnecessary risks. I'm not against speculative stocks or penny stocks for that matter. In fact, I strongly believe that every portfolio should have a certain percentage of stocks which are speculative in nature. The bottom line is that you should not let emotions affect rational decision making. Now, if you enjoyed this video, please click the like button, and if you are new to this channel, please click the subscribe button. Also, comment below and let me know what other topics you would like me to cover. If you would like me to review a particular stock, please do let me know. Till then, see you soon.